Welcome to January Options with Isaac. So, apologies for the bad handwriting, but I am not skilled as an artist. So, these are just a high level view of the process for how this works. If you're new to options, we're going to move kind of fast because I want to keep the video short. But essentially, we have a target price. This is the share price that we're aiming for in the contract, the expiration date, when the contract will expire, and this is the premium, which if you are selling an option, this is paid to the contract creator, that would be me, the number of contracts for each line. This is the date that the trade is initiated, and this was the share price approximately when the contract was created. So the way this works is SoFi went up to a high of $17 and they dropped to 15. This was around middle of December. So watching the share price, I'm like, okay, this is a temporary dip. We're going to go ahead and sell contracts just below the share price. So this is a decent amount of premium. And then early January, it dipped further into the low 14s, high 13s right here. And we sold some more contracts for an even higher premium, dated a little bit further out into February. So what happens with these contracts is if the share price for SoFi is below these dollar amounts by this expiration date, then I am forced to buy 100 shares per contract for each of these contracts that are open. So let's say, for example, February 207 runs around and SoFi is actually at $14.90. Then I will buy 500 shares at $15 a piece. And this money is already set aside in an escrow account. I've pre-funded all these options. That's why they're a cash secured put and not a naked put, for example. And that's like the worst case scenario is if the share price continues to drop down $11, $12, somewhere down there, and I'm forced to buy it at a higher price. However, if the share price maintains a flat trajectory or if it goes up, then the value of these contracts will drop significantly. And in that event, so 116 rolled around today, and I decided to buy them back. So the $15 put here, which I was paid $1.56 per share. Every time we do options, it's always 100 shares. So we take the decimal point, move it over. This is $156 per contract. And this was on January 2nd. So we go 2 weeks to the 16th. And this $15 contract I bought back for $80 each. So essentially, I was paid some change, and I bought it for 400 for a net profit of 380. The $14, the very first one we opened back in the middle of December, I was able to close that out for, a very low amount compared to what I was paid. So I had a profit of 360. And the same for all of these. Basically, net profit came out of here. So 36,000 was the total amount of collateral needed to run all of this. Dividing that out, we get approximately 22.7% rate return on investment in about 30 days. We're just a little over 30 days with the 19th through the 16th, but it's not a bad rate. People ask the question, why not just take the 36,000, buy shares of the stock, and buy it up at $15 and sell it today when it hits 16, or something like that. There's a couple of reasons for that. this is actually a less risky approach. You don't have to commit to owning the shares. Also, about half of this is margin. So if I buy shares outright, I'm paying an interest rate to have that margin loan open, whereas I don't really pay that interest rate with the current brokerage just to hold collateral for a cash secured put. And I can back out of these trades cheaper than I can back out of owning 36K worth of the stock by itself. So this is a way to take advantage of the manipulation of the price movement of a stock without necessarily committing to just owning it outright and all the associated issues with that in terms of risk and whatnot. But yeah, this was just the last 30 days. And if you're interested in learning more, feel free to hit me up with any questions. Thanks, guys.